Well, John Taylor with JRW Investments is here with us today for another episode of the Wealth Transfer Podcast. He was actually one of our first episodes. You can go back and listen to that original episode. But I brought him back because I wanted him to give us some of the advanced real estate planning strategies that some of his clients and that we're seeing out in the real estate wealth space. Because many times when people get to maybe a certain age or a certain level of real estate wealth, they start to figure out, how do I start not having to manage all this or deal with all these things? And what are some of my options? And I've seen John give some great ideas. So I wanted to bring John back. He is as a wealth advisor and helps people specifically in Delaware Statutory Trusts and DSTs and advising on potentially which ones to go into or how to 1031 exchange those real estate properties. And so I'm excited for John to unpack some of that knowledge again for us today, and also to hit on some of those advanced real estate planning strategies. So John, is there anything I missed? Tell us more about your bio or anything else people need to know about how you work with real estate investors every day to help them plan their wealth.
Sure. Well, first of all, Matt, thanks for having me back. I appreciate it. It was a compliment to be asked the first time. It's an additional compliment to come back again. I have actually watched the majority of your Wealth Transfer Podcast episodes on YouTube, and you've got a lot of good guests on here, so I'm happy to be back again. For those of your audience who maybe wants a high level, don't go back and watch the 45-minute previous. My office, so I work for a wealth management organization called JRW Investments. We have been focused specifically on sourcing real estate investments through a really disciplined due diligence lens and filter for the last 30 years with our clients. And the primary vehicle that real estate investment is held within is called a Delaware Statutory Trust. Before that vehicle was given an IRS revenue ruling in 2004. So prior to that, it was the tenant in common structure. What those all have in common is they're built for the investor who has highly appreciated real estate that they own and control locally, likely. It could be a single family home, or it could be raw land, or it could be a commercial property or portfolio of a variety of things. But what they're looking to do is to sell that asset, that investment property, and they don't want to pay the capital gain that they've incurred over the years. And they're looking for real estate advice through a tax lens, through a macroeconomic lens, and through a real estate acquisition lens. And we have provided that for clients. Today, just for context, today we have exposure to about $18 billion worth of commercial property in a variety of structures, but the majority of which is in a Delaware Statutory Trust structure. And our clients own about $2.5 to $3 billion worth of that 18 exposure. And so we have a kind of front row seat, and that's over the last 10 years, by the way. So that's just kind of taking that chunk. We have a front row seat to how investments that we've recommended in the past are performing, and then also where investors who are looking to transition their current real estate portfolio using this 1031 exchange mechanism, what current available options exist.
And I've referred clients to you because oftentimes people have heard about this idea of Delaware Statutory Trust, or they're kind of wondering about it, but they're not sure, is it safe? Is it the right choice for me? How do I do it? And you're really great at educating people on all of the pieces and how to make the right decisions. What kind of clients come to you, and how do they come to you? Who are the types of people you're seeing that are looking or interested in this?
Yeah, so we're fortunate in the sense that our firm's been around for a long time. We're in Southern California. We originated as a tax practice. So our founder's name is Warren Thomas. He continues to play a vital role in our firm. He's over 70 years old at this point. But the majority of our equity that we steward and place, new capital that we place every year, is on behalf of existing kind of clients and friends and family of those clients. It's probably 75 to 80% of the revenue that we're responsible for annually. The 25% of brand new equity to the firm from outside sources, which is a relatively new concept. We were really built insular for in-house clients for a very long time. But for the referrals that we get in from folks like you, or just inbound, investors, they're primarily done building their portfolio. Like I'll talk about like the progression of a real estate investor's career as you're building and growing as kind of a first stage, you're maintaining and optimizing at a second stage, and then you're preparing for a transition as a third stage investor. And the majority of our investors are in that third stage, and they're either retired or they're planning for retirement. They're thinking about their overall financial balance sheet, and real estate takes up more than 50% of what they own or control. And real estate represents the largest challenge from an estate planning standpoint if the kids aren't in the business. And so we get a lot of questions about the structure for sure. And I like to tell people early on, the DST structure is a wonderful, unique, one of a kind structure for some people, but not for everyone. And there are things about it that would I would agree with the investor. I would advise that the investor not pursue the DST for certain reasons. Once you get into that, is it a good fit for you, the structure piece? Then there's this whole nother conversation around how do you navigate the market? How do you say this is the right investment for me specifically, individually, and this one isn't, right? You have to have a thesis for that. So that's a typical conversation I have early on with that retiree investor.
Great. So retiree investors, someone who's now in the preparing to do something with that wealth that they've accumulated in real estate, and then you help them assess, am I the right candidate for this, and which property or which opportunity is right for me? Is that what?
That's exactly right. Yeah, I'll start working with an investor who just has a portfolio, who maybe would raise their hand and say, I would sell this tomorrow if I didn't have to pay capital gains tax, but I have to pay the tax, so I can't sell it, and I'm stuck. Oh, somebody, a friend, a family member, a CPA, an estate planning attorney, a Matt Templeton might say, have you heard of a Delaware Statutory Trust ownership structure that enables you to sell and go into a passive income investment? And then so I may talk to that investor for 6 months to 4 years before they ever sell a property, but they're kind of accumulating industry knowledge from me along the way.
I think that's exactly what I hear all the time from investors, especially like you said, a retiree investor. I would sell tomorrow if I didn't have to pay capital gains tax. And really it's just a making the plan and figuring out how to still maybe create cash flow, oftentimes more cash flow, less hassle, less maintenance, less calls on the weekend from your tenants, and move that money through a 1031 exchange into something like a DST. And partly, I think the industry has talked about planning from a money perspective or a wealth perspective around other assets for a long time, making sure your portfolio is balanced and figuring out what how things are going to look, and when you're going to go to less aggressive, less growth oriented investments to things that are more passive and paying you all that planning. I tend to hear around non-real estate assets. But the funny part is that, like you said, many people have, many, at least the real estate investors have at least half or more than half their wealth in real estate. And then when we think about this idea of wealth transfer, many retiree investors moving their wealth to the next generation or using it to live off of in the end of their life, a lot of that wealth is actually tied up in real estate, the majority of it, right? Trillions of dollars set up in real estate, but there's not been a way of planning or making, it's kind of like, well, we just kind of wait and see what happens, and we'll see what the property's worth when it's over. But there might be some really strategic ways to increase quality of life and deal with some of the issues that come with managing real estate. And so that's where what we recommend is let's make a plan. You don't have to sell it today or sell it tomorrow. Just because you could start to figure out, what do I want to do? And that's where I want to ask you, when I think about advanced planning for real estate, I think about saying, okay, what would I want to use this money for? And then how do I bring that about over the course of 1, 2, 3, 4, 5 years, so that I'm not in a bad situation, or I'm not forced to sell, or I'm not stressed by this process, but I've actually been strategic, and now I get to make really cool decisions. And so I would love for you to share any of those, I call them advanced, but any of those strategies where you say, okay, if you would think about it this way and put a couple year lens on it, you could actually make some really cool decisions that might help your family or help you in kind of this real estate planning zone.
I can answer that in generality, or I can kind of point and shoot at a few recent scenarios that I'm working with clients right now on. So I'll start with the scenario, and then if you want me to kind of zoom out and talk about how that applies generally, we can. I have a client who actually was referred to me through Keller Williams agent, who has this kind of planner mindset around real estate, very unique. Matt, what you do, and if your audience doesn't know this, I'll just kind of give a plug for this. I talk to a lot of real estate agents and brokers, and Matt represents the top 1%, of an understanding ultimately around how do we navigate decisions for clients rather than just how do we sell stuff or how do we buy stuff for clients, right? It's the consultative approach that you take is incredible. And the clients that I've referred to you have been really appreciative. So I'll just kind of set that aside. This came from a similar like-minded agent to Matt, and it came to me. The investor owns stuff all over the country. He would move. His job moved him around, and every time he moved, he'd buy a house, and then he'd get moved again, and he would own that. He'd keep that house, and maybe he'd buy another investment property as well. And so he's got stuff from, Florida to California to Montana to all over. The majority of which is single family homes, and the majority of which is paid for. Some of it has debt on it. And he has been in that phase two, that like maintain and optimize for some time. And he's interested in moving to that phase three and preparing for the next generation, the next phase of life, this retirement. And he's like preparing for retirement. He's not into retirement just yet. So what we've done is we've used the DST as I'll call it a partial or a hybrid exchange product, where the DST has not been the primary focus of this investor. He's not saying, I absolutely want to get rid of everything and I want to go all into DSTs. What he's saying is, I want to be really strategic with what I buy, and I want to swap out assets that are not optimized anymore for the right asset for my next, for what I'm preparing for. He's got some children who he wants to kind of cultivate into being a part of the real estate business. And so he's taken kind of this approach where you look at two properties, maybe they're in two very different areas, and you sell them in a similar time frame. And what you'll do is you'll aggregate more equity by selling two, and then he's going out and he's acquiring something with one of his children as a quote unquote like business partner from a operational standpoint, not necessarily like an ownership standpoint, but they're working together on sourcing and vetting and acquiring, and they'll buy this property over here that they love and they want to work on together. And then they'll have this balance left over. And that balance left over is really difficult to place. Most people just pay tax on it. And so he's using that balance as let's take this $150,000. We just bought this 850 thing over here, this 1.2 thing over here. We've got 150 grand left. Let's put that to work for us in a highly stabilized commercial property that's structured as a DST, so we can do it fractionally. And it's sort of, a way to get into the DST world. But now if I can up level this strategy to like a more advanced, what they've done is they've bought the property, the traditional property, all cash, right? Him and his son. And that all cash property, now he's very competitive, right? The best time to buy is when other people can't. A lot of people haven't been able to buy in the last 18 months. Interest rates have been high, et cetera. So he comes in as an all cash buyer and has picked up some really great properties in various places. And then what he'll do after he buys all cash, he'll take a loan out against the value of that property and use that loan as his renovation and rehab budget. Right. So like a really cool opportunity. He's kind of partly optimizing, right? Part phase two, part phase three. The DST portion is the preparing portion. And then he's optimizing, he's taking problem properties and turning them into opportunities somewhere else in his balance sheet. So that's a really fun one.
That is a super fun one, because I feel like you gave us 5 strategies in one. And, the scenario itself is its own strategy. But I think a couple things I heard was you can use your selling of your real estate investments as cultivating both the knowledge and relationship with heirs or with kids or with whoever the people are.
Yeah.
And I actually was talking to someone a few weeks ago, similarly was selling off kind of the portfolio properties they'd already had. And then they were 1031ing into other properties with their kids. And it became sort of a family business. So there is that option. Some people still have that as a runway, do as a family business.
One caveat, just real quick for your audience. When you do that, you still, as the investor, right, as the retiree investor, you still are the owner of that property. But perhaps you may make an amendment or a supplement to your trust where that child that you're quote unquote in business with over here, that child will become the sole beneficiary of that individual property. Which you can write the trust however you want. It doesn't have to be just like divide everything in thirds. It could be this child gets this property at this address because they were instrumental and fundamental in that thing. What you don't want to do is put your kid on the title of that investment property, because they lose all the tax benefits that you've deferred.
Exactly. The other thing I heard you say was aggregate multiple properties. Maybe you've got smaller properties, put them together. You've got more buying power. That's in itself a strategy. I think also the idea that people forget that when you've got a little bit left over, maybe you weren't able to buy the full, that you use the full amount of available equity, and then you're just going to pay tax on the last remaining 150 to use that as the DST, right? Maybe you did find a great property, but you wanted to put some of it into a DST. I think that's a great idea.
Here's one for you too, just to double down on that. I did a $60,000 DST investment this year. And here's why. I initially advised the client not do it. Hey, your tax bill is not going to be that high. You can probably afford it. You can raise the capital. And it's not, I'm happy to write the ticket at whatever size. I encouraged him to do, though. And I asked the question, do you benefit from any income-based programs at all in your current situation? And he had a healthcare program, a Medicare, Medicaid program, that was the price that he was paying on a monthly basis was based on an income threshold that came from the tax return. And I want to remind the audience that your capital gain from the sale of your property, whether it's 60,000 or 150,000 or 1.5 million, it's all income. So that adjusted gross income on your tax return is taxed at a different rate than ordinary income tax rates, but it's still income, and it will impact maybe mom or dad's ability to qualify for the senior care assistance that they're getting, or any sort of subsidized program that they may qualify for. So it's always good to check that before you make those decisions.
That's a great point. Yeah. So the tax, it wasn't a big deal, but the losing the program or not having to get the same price for that program, that could have been detrimental for sure.
Well, it would have raised, very practically, it would have raised his healthcare costs from like $800 a month to like $2,100 a month. Like it was and that's kind of a long-term locked in situation that he would have been, that would have been a multi-year situation.
So I think another one that is really important, and I talk to people about this a lot when we're talking about real estate plans, especially if they're planning on keeping the real estate and they're not moving out of the illiquid assets like real estate into more liquid assets, is figuring out which properties are going to which kids so that the kids don't then have to share those properties in the future. And I call them kids, but any heirs or children or whoever's receiving those properties in the future. Because one of the biggest issues we see is that illiquid assets, real estate being one of the main illiquid assets, tend to create fights later when people have to then share those things.
Yeah.
And
yeah.
I love the idea. I think for the longest time, people have thought, well, we need to make it equal, right? And some people are of a different opinion. They just maybe don't go equal. And that also creates its own fights. But equal doesn't have to necessarily be at time of death. Equal could actually start at a certain point. It could start today. You say, okay, we're going to take these current assets. We're going to decide whose is whose now, and we're going to keep them titled in generation one's name, because you obviously don't want to lose that. It's the number one thing, right? Don't change the title, because you're going to lose the tax benefits of even doing these 1031 exchanges if you put it in there's the carryover basis. But then Gen 2 can already know this is my inheritance, and I can begin kind of maybe participating with my parents or participating with the Gen 1 in that specific thing. And so that would be okay. Again, we figured it out at maybe today's values that everyone's getting equal distributions, but then we don't have to make sure that those are pinned to the future. Or if we do, we could always have some cash in the trust or something else set up in order to make that equal again later. But I think that's a great idea, is to say, why don't we figure out what each heir wants in real estate or in other assets? And let's figure out how we can kind of divide it up so that they get what they want instead of having to get stuck with something they don't want.
I'm doing an exchange right now with an investor family who's sold a property. It's a Bay Area, San Francisco Bay Area property, 2.4 million approximately. And they're going into business with their son to acquire a property for 1.4. That the son is really the driver, the brain for. He's not on title, right? It's not an actual LLC. It's all loosely arranged, but their son is very, very involved with the selection of this property and will ultimately be involved in the management of it. And they've got, another portion of their estate plan that's really, they want to turn it into cash upon their passing. So I'll double another advanced strategy. There are some states that are community property states, and a community property state is important to it's California as well. It's important to understand the implications for a married couple in a community property state, because when one spouse survives another, that surviving spouse receives a full stepped up tax basis on their investment property portfolio, as well as other assets, right? But the reason why they're moving the million with me is because ultimately they want that to turn into cash for the surviving spouse. And let's say, I think statistically speaking, let's just assume husband dies first. So if husband passes away, and the wife will be able to participate in when the liquidity of the investment that I've advised her to participate in, when that liquidity event comes, that tax liability will have been eliminated. And I will advise that she just take the cash proceeds and then work with the financial advisor to rebalance that cash in a way that makes more sense for her current life stage. And that's a really interesting way to think about, like, this patriarch real estate investor has now invested in his relationship with his son and created a path toward kind of business, right, with the son. And then also really taking care of his wife should something happen to him, before her.
We do a lot of work in community property states. Those are like two of the states we do a lot of our work in are both community property states. And so I'm used to thinking that way, right? Like oftentimes I'll talk to a widow, and that's the best time to sell is because within a year or two of you haven't had that much maybe new appreciation. Now you're only paying tax on the small appreciation. Maybe it's even gone down in value since the passing. And it's a great time to be able to get that money liquid and then know that you've got the security and put it into something more, maybe a new asset, and not have to deal with the management issues. Yeah, I think that's a really important thing that I often talk to people, married couples in community property states. One of the other things you brought up, which I think is a really important strategy to think about, is in a couple contexts, is the refinancing to get cash out. And I don't think a lot of people realize or know that refinancing a property that you've done a 1031 exchange on, or that you have very low basis in, or you've got a bunch of potential capital gains if you were to sell, refinancing is not considered it is a cash event, but it's not a taxable event. So it gives you an opportunity to pull cash out and utilize cash for all the life things that you might want or other investments you might want without having to pay tax for that. As long as you're still holding the property for investment and you're not trying to pull money out and then sell it immediately, right? There's some strategy you got to be careful of around what the IRS rules are. But in general, refinancing is a great thing. So an advanced strategy that I think people really need to think about is the idea of, let me buy with cash and then either refi out now after I've bought with the 1031, or refi out maybe a year or two before and then go into the DST. So maybe you're seeing that regularly where people are kind of planning several years in advance so that they can do those refis ahead of time.
Yeah, you need to have three parties at the table who are more interested in the client than their own business in order for us to pull this off. So I'll just kind of describe those parties. And we'll talk about the retiree, and then remind me, let's go back into those other two phases and we can talk about how that applies. But there is no tax paid on a refinance, right? The only way to take a property, an investment property, and take money materially, cash out of the property, is a refinance. So you're right, there's there's three ways that debt really impacts my world. The first way is when an investor has debt already. Maybe they use debt to buy the property, they haven't paid it off yet. When they do the 1031 exchange, they need to acquire property that is at the same net value of what they've sold. And so if there's a loan on that property, the equity becomes a down payment, and then they need to find an equal or greater loan, typically, to round out the total exchange. And the DST market provides in place non-recourse financing for investors that is, you don't qualify for, you don't apply for. It's just a part of the investment structure inherently. And we'll call it, just for purposes of the podcast, 50% is a pretty average leverage point. And so for an investor who's evaluating a DST with 50% leverage, any equity that they're bringing into that DST is just a down payment to close on double that, right? They're bringing 100,000, they close on $200,000 worth of real estate, and they receive the benefit of that $200,000 loan. So how can we use that to help investors? Well, it's the traditional way, right? For investors who need debt, they can use the DST just for the debt side, right? Let's say they've got a $1.2 million property and $200,000 worth of debt. Maybe this is like my guy earlier, right? He puts $200,000 down with me, right, through my guidance, and then he has the rest that's all cash, unencumbered, and he can go and acquire something else outside of the DST universe. Or let's say I've got an investor who has an all cash portfolio today, right? Single family home or duplex or what have you, and they're over concentrated in real estate. That investor could work with a lender because they have an asset that's performing and use that asset as collateral and borrow against it. And that could take a real estate investor with an over concentrated real estate portfolio and start to move some of that capital into the management underneath of their financial advisor, perhaps, or to do whatever they need to do with cash that they couldn't do through a 1031 exchange. That needs to be for business purposes, right? For investment purposes, not just to go buy a boat or to spend, right? It needs to be underneath of the advisement of your professional team. But you also need to have that loan in place and seasoned for 6 to 12 months prior to listing and selling the property. It can't be a tax avoidance strategy. It really needs to be a part of a comprehensive business plan. So again, doing that alongside of and under the guidance of your professional team is important. So that's like kind of the second way. And then the third way is like I described earlier, you could 1031 exchange an all cash property and then refinance out directly as a way to either use that for an improvement budget or to reposition that equity into an alternative investment that's not real estate.
And then what about the investors that aren't in the preparing phase, but they're in the maintaining or building phase? How they might use a loan?
I mean, a lot of your audience who's in that prepare phase will remember their growth. Like many of you borrowed against your properties to go and do things. Like maybe you borrowed against, I just talked to a guy, borrowed against his property to go pay for his daughter's wedding, right? Like he borrowed against his property to then go and buy another property, right? So sort of like you borrow against the assets that you have in order to grow the assets that you have. So those builders, most of them aren't just taking W-2 money and then putting a down payment down on their next property. They're buying a property, using the W-2 money maybe to improve it, right? You put $1 worth of repair budget in to create $3 worth of equity value. And now all of a sudden you've grown this thing in value. Well, you can refinance that, take that money and put that money as your new down payment. So that's what a lot of my investors grew that way. A lot of my investors currently, like they bought their properties right after the global financial crisis. Many of them, some of them older investors, they bought in the 90s, but they've built that way. They've recognized that the appreciation is just paper unless you sell it, but they can't sell because the capital gain. And so borrowing against that appreciation is a way to unlock the equity.
That's awesome. Any final advanced real estate strategies you're seeing in the planning space, especially for those retiree investors?
Yeah. So we talked about two. One more I'll bring up is that the Delaware Trust could be a backup to a traditional property acquisition strategy through a 1031 exchange. And so what I mean by backup is a lot of clients, when you talk to them about the tax advantage of the 1031, they may bring up some concerns. They may say the 45-day window is too short. How am I going to find something? What if I don't find something? I'm not sure. The DST, if it's the right structural fit for the client, right, suitable for them, and we've educated them on the market and the options that exist there routinely are a benefit, that could be a really good plan B, where the investor says, what I really want to do is buy this house in Colorado. If I can't buy the house in Colorado, I'm comfortable with putting that equity into a DST. And so on my identification sheet, I'm going to use the DST as a backup. I'm going to go for the Colorado house, but I want to give myself the freedom to back out. I don't want to get, handcuffed into buying something I don't want after a due diligence period. So it allows you to, I think, have the confidence just to go forward with listing the property and selling it, knowing that there absolutely will be a very good investment for you. And it could be a DST or it could be that traditional property that you really want. But I've seen many, many times where an investor will call me and say, hey, I got the property in Florida. Like we're closing in a week. And I'll say, congratulations. Like I'm super thankful to have been a part of that puzzle. I don't make any money from that, right? They didn't buy the thing that they used me for. However, the DST is always a little piece of a bigger puzzle. And the bigger puzzle is the only thing that I care about.
That's perfect. John, where can people find you for strategic consulting or for more information on getting into DSTs if they're interested in that?
Well, if you're watching this on YouTube, the link is in the description below. So you feel free to reach out. Matt will put a link to my calendar or my email down there. My firm is JRW Investments, and the email the web address is jrw.com. So really easy to find. And I think maybe just to lower the impediment, like my time is spent consultative and educational with new clients a lot. And so if you have questions or concerns, we have a lot of resources that I can direct your way, and you can self-educate, or I'm happy to have a conversation with you directly anytime.
As a bonus, I actually sat back down with John and wanted him to give us the basics of DST. So if you've listened to the other part of the podcast and you're wondering, what is this DST thing all about? I asked him a bunch of pointed questions about DST, and he broke down more of the specifics just about Delaware Statutory Trusts, what they mean, who they're for, and how to use them as an investment vehicle. So, John, you work with JRW Investments. You guys strategically advise on Delaware Statutory Trusts, DSTs, 1031 exchanges, on strategic real estate wealth investing. But a lot of times I talk to clients, I'm in real estate planning. I help people think through how to sell their real estate portfolios or what to keep, what not to keep. People are always asking me about DSTs and about 1031 exchanges, and they've got a lot of questions. So I thought I could ask you a number of questions about them and even maybe get into the nitty gritty. And you could, being the educator that you are, give us a bunch of insight into, well, are DSTs the right investment? Who do they make sense for? What are they? What are 1031s, et cetera? Give us just the 30-second version of what you do and who you are.
Absolutely. Thanks, Matt, for having me. I appreciate it. It's always fun to talk to your audience through this format. Really simply, the DST is an ownership structure, right? Many of your investors, they may own property in an LLC, right? The DST is the ownership structure by which investors can take title to a property fractionally. And the typical DST is a large, stabilized, conservative, institutional blue chip property that could be a $25 million property, a $50 million property, or a $500 million property, right? That's already acquired, that's in inventory, and that investors can buy in pieces and parts relative to their exchange needs. And 99% of the time, the investor who acquires this type of product is in a 1031 exchange.
So someone could buy into these without doing a 1031 exchange?
That the sponsors that are selling their equity, they'd take any money that's green. But the primary investor who's attracted to these types of extremely stable, conservative, the DST market normalizes around cash flow. And so most of my clients they built wealth portfolios, they bought much more risky assets than what you'll see in a DST. And so they're focused on consistent monthly cash flow and protection of capital, because it is a tax advantage tool more than a growth on speculative, hopeful type of real estate project.
So in the majority of cases, someone has owned real estate of maybe different kinds of real estate. It doesn't really matter what kind. They've maybe held it for a number of years, sometimes even 30, 40, 50, and they're no longer getting depreciation. They would have a big tax bill if they were to sell it and sell it traditionally. And they decide to use the IRS tax code, Section 1031, which allows them to transfer into like-kind property, real estate to real estate, and they're moving into a different type of real estate that just happens to be owned in what's called a Delaware Statutory Trust. And this specific these properties that they might be buying into tend to be, you said, very stable, tend to be very big projects, commercial sort of projects. What kinds of tenants, what kinds of properties are inside these DSTs that they're potentially 1031 exchanging their money into?
Yeah, good question. So the industry today, this may or may not be surprising for you to hear or for your audience, but there's 59 different sponsors. They're called institutional real estate companies that are currently participating in today's market. And today is April 2026. Okay. So 59 different companies have brought to market 101 different DST investments. That's the entirety of the market. That may sound like way more than you thought, but likely it's way less than you thought. And so by the time that one of those DST investments is on the market, quote unquote, that sponsor has already purchased the property, they're operating the property has cash flow that it's producing, and that sponsor actually owns that property 100%. So they're selling interests in incremental pieces and parts to investors out from under their own ownership. The typical investor, as you said, is a real estate investor who has highly appreciated real estate. And so they have a tax problem. Okay, that's like the number one question that I ask the investor to try to understand is, what is the implication of your tax problem? Because if there's no tax problem, then we can just simply sell the property and take material receipt of the cash and walk away, right? A lot of investors, if I ask them the question, how many of you would sell tomorrow or list tomorrow if you had no capital gain implication? A large majority of my clients would list tomorrow if they didn't have the capital gain. So the 1031 exchange has been around for a long time as the tool to navigate the tax problem that they have. And the DST ownership structure qualifies for that 1031 exchange because the ownership piece is disregarded. It's really the property itself that you own fractionally that goes on your ID sheet. And so that helps investors avoid or defer the capital gain on that transaction.
Okay, so if somebody does a 1031 exchange or they meet with you, they decide they're going to do a DST, how do you help them select which DST? You've got 101 options. How do they pick which one to go into?
Yeah, I mean, we spend a lot of time answering that question every day. We talk about this framework for how we navigate the DST market. So the first thing that we want to understand about the investor, right? Because we're looking for a fit. Like if you go to our website or you hear me speak, like the purpose of JRW is to source real estate investments that are appropriate for individual investors through a disciplined due diligence lens. Okay, so we source, it needs to be specific to an investor, and it needs to be through a disciplined due diligence lens. We are every day, we've got a due diligence committee that's larger than our advisory committee, our registered representative group that serves clients directly. We have more due diligence folks than we have representatives. And so every week we're getting a new opportunity that hits our desk. Likely it's not quite yet formed as a DST. The sponsor is currently forming the investment structure, but we get the due diligence package and we're looking at the price of the property to the investor, which includes all the fees, right? We're looking at the location, the tenant, all of the demographic information. We're looking at the potential exit strategy. How does this property do under stress? What is the revenue model? What are the expenses? And what could change throughout the hold period of that property? And for any investor who hasn't had experience with commercial property, they're going to want to participate in one of JRW's due diligence seminars where they take advantage of and understand, like they'll get a bird's eye view of how one of these DSTs is formed and what we care about inside of each DST. And so how we navigate the market for investors is first we have to know the investor, then we have to know the entire market, and then we can find that fit between the investor and the market. And remember, I said there's 100 of them today. I think we're highly, highly confident generally about 7 or 8 of those 100. And when I'm talking to a client, I'm probably not going to recommend more than 3 for any individual client because of the nuances of the client and the specific deal that we've approved.
So somebody decides they would sell their property if they didn't have to pay tax. They learn about 1031 exchanges. They decide that DST makes sense for them. They meet with you and they find out which of the 3 or 4 or 7 of the 100 that makes sense for them to potentially invest in. And they decide they're going to sell their property and move that money into a new real estate investment where they own part of a much bigger commercial project. And in owning this DST, what are the benefits of it? So they owned their property wholly and they were maybe getting some cash flow. They had to do some management. What are the benefits now of owning this DST or owning part of it?
Yeah. So the benefits, I think, are what attract people to this concept in general. So most of your audience have heard of these. I'll run through them, but we should also talk about the considerations and the downsides. I spend a lot more time thinking about that on behalf of my clients than the benefits, but you get cash flow. Typically it's monthly cash flow and it starts on the day that you invest. These properties are stabilized already and they're currently owned. So we're not going and sourcing something with your cash. What we're sourcing are in place, in inventory, for sale interests of real estate. Another benefit is the diversification potential. Most of my clients, they own a specific geographic location or a specific asset class within their personal portfolio. For instance, like all single family homes in Southern California, or all like one big commercial property in Texas. So the opportunity to take that concentration of strategy and say, okay, now I want to acquire a little bit of a $100 million multifamily apartment building, or a slice of this Amazon distribution center, or a $150,000 interest in a $60 million student housing multifamily apartment building. That's the diversification by asset class. You could also say, like the three I just mentioned, I want to take my $1 million exchange or my $300,000 exchange and chop it up into three different pieces. So now I've diversified across all three of those with one exchange, as well as, out of my local area. Another benefit, I think the due diligence potential in the DST market is like a big benefit. You've probably worked with investors who you bring them a property locally and they have to make a decision like right now, like, are we going to do this or are we not? It's competitive. And the DST allows my team months to review a property prior to it even being formed as a DST. And so we know exactly what we're buying. And we have had the luxury of time as a due diligence wealth management office to know with high confidence whether we're going to participate or not. Most of the investors who come to me for the first time are drawn to the benefit of passive income. The DST is truly the only structure that you can invest in through a 1031 exchange that give you complete passivity. You get a mailbox check every month and you make no management decisions and you experience none of the management burdens. Another one is timing. So I can close on a DST in a week. Right. So because it's already in place, if we have your account on file and we have all the necessary ownership information, we can help you subscribe to a investment in, 5 business days pretty comfortably. So that takes that 45-day concern completely away. All the rest of it is pretty much real estate, right? So the tax deductions, the stepped up cost basis, the income is Schedule E, ordinary, rental income. You have limited liability. There's nothing that can happen in that project that would kind of come after your balance sheet. If there is debt in the project, it's non-recourse. So that means the property is the only collateral. My investors are not signing for or applying for the debt in the DST. That's probably the majority of the benefits that people are looking for. It's a passive income investment primarily.
And so when you say passive income, I assume you mean mostly that it's got cash flow. So what does cash flow look like, or how do they distribute cash?
Yeah, so cash flow, you own a percentage of that property, so you are the economic beneficiary of the property's economics. So the appreciation is yours fractionally. If the property goes down in value, you're on the hook for that, right? It's an investment that carries that same risk if you owned 100% of it or 1% of it. The same goes for the income. Your income is determined by the gross revenue less all of the expenses, and that difference, that NOI difference, is distributed to investors fractionally based on their ownership percentage. Typically, it's monthly income. And from an amount standpoint, in today's market, you'll see something anywhere between 4 and 6% of the equity investment is the profitable distribution of the income that investors can expect. So for a $100,000 investment, a $4,000 to $6,000 net profit income is something that they can expect.
Okay, great. And you said it goes on the Schedule E for tax reporting. So it's like you own a rental property. Are they sending you a 1099 and then that money is what your CPA puts on? How does the tax reporting work?
Yeah. So typically it's a 1099 or it's a grantor letter that shows the gross income, right? The gross income is the top part of your Schedule E on your tax return. That's not what has been distributed to you. That's what the property's generated. And then they'll provide you with a P&L that shows the individual expenses that are attributed to your ownership percentage. You'll calculate your own depreciation with your CPA based on your unique tax basis that you brought with you into the investment. And then, that bottom number is your net income number that you're paying tax on. So you get a custom P&L for your percentage of ownership.
And if you're moving into a new property, now you're getting new depreciation that maybe you didn't get previously. Right?
Yeah, that's exactly right. Yeah.
Now, obviously, a lot of times people are choosing this because they are retiree investors. They're ready to start preparing their estate and making their assets passive, easier, but also prepared for the next generation. How's DST handle when it comes to estate planning and preparing for, okay, we actually want things that are easier to transfer to the next generation?
Yeah. So I'll tell this as kind of a narrative. Let's assume there's an investor with 2 investment properties. They're both worth 500,000. Okay. And as happens often, the investor's working with me and we identify like one of these properties is definitely the first one they want to sell. So they go through the process. They sell this property traditionally, right, through their local trusted agent or broker. They open up the qualified intermediary account and they select through my office a DST that's suitable for their goals and objectives. Okay, so now what does this investor have? They got $500,000 worth of this property that's structured as a DST, and they still have this $500,000 home or investment property that they've owned traditionally. Now, in this hypothetical narrative, this investor passes away. And let's talk about what happens with his portfolio. The investment, the DST investment is automatically, let's assume that the investor has 3 children. The DST investment is automatically divided amongst the 3 beneficiaries and assigned individually and independently to all 3 of those beneficiaries. Those 3 beneficiaries get a stepped up tax basis, and they all 3, working with me, receive individual monthly checks of 1/3 of what dad was getting. Right. So what have we done? We've completely created an independent on these 3 children, and they're now continuing to participate in the same passive income investment that dad selected with our office and through our guidance. A typical DST runs for 5 to 7 years prior to it being listed for sale, the property listed for sale by the sponsor. And when that property is listed for sale, those 3 children will receive individually and independently their pro rata share of the proceeds of the sale. Okay, so that's the DST side. No tax implication, right? Because the stepped up basis, they take the cash, they do whatever they want. And maybe they have very different goals. Now, what happens with this other $500,000 property over here? Well, that trust that directed the investment to the 3 beneficiaries went from a living trust to an irrevocable trust. That irrevocable trust effectively is a tax-paying entity. It's like a business. And those 3 beneficial heirs are business partners now in managing the assets in this trust. And so now these 3 children are codependent on one another, making decisions on behalf of one another. For do we sell the property? Do we refinance the property? Do we change out the tenant? Okay, there's an expense. Who pays for that? Who's kicking in cash for that expense? They're business partners as a part of this overall thing. Same stepped up basis, and they can sell that property, but they have this added layer of codependence, whereas the DST provides this benefit of independence from one another through the beneficiaries.
I mean, it's a great way to explain it. And I tell people all the time in my role that the owning those properties together, that codependent relationship among siblings often does not go well, right? And sometimes you can already foresee that as a parent looking at your children. You realize, well, they're not going to necessarily get along very well in managing these things together. But sometimes you think they might get along, and they still struggle after. I mean, so much sibling pain comes from dealing with estate issues after mom or dad has passed. And I think you hit the nail on the head. The DST is an immediate separation, and you've got that ease. And then when the property goes to sell, they each get their distribution with no capital gains tax implications with the stepped up basis.
Most of my clients didn't inherit anything. They created it all themselves. And so they have never seen how this happens, right? They didn't inherit it from their parents. And they probably don't have a plan. So they need to speak with somebody like you or somebody like me who has seen this happen many, many times on behalf of our clients to really think strategically about that. The clients I have who have inherited something, most of them have a painful story around how that went. So it's a good conversation to have with someone like you.
And then are there any fees associated with the DST investment? How does the sponsor get extra money? How does that work?
Yeah, it's a for-profit industry. So there's 3 parties that are kind of involved outside of the investor in managing and brokering and facilitating this entire investment. So it's the sponsor company is one. That sponsor company is the institutional real estate company that they're the ones who went out and sourced the property from the street. They've acquired the property with their capital. They've created the inventory, and they're selling it out to an investor. They also are responsible to put the property manager in place, and they're also responsible to sell the property on the back end. Okay, so that's the first party. The second party is the property manager. So oftentimes it's a best-in-class local property manager for that asset class. If it's an apartment building, you'll recognize the name of the 300-unit apartment building. You'll recognize the name of the property manager because they likely manage other properties locally. And they take a percentage of the income, just like you would expect. If you owned the property yourself, you'd hire that same manager. The difference being, if you own a single family home, you're probably paying 8 to 10% of gross rent to your property management group. For these larger institutional assets, it's like between 0.5% and 2.5%, maybe at the absolute max for a high management burden type of asset in the DST market. So that economies of scale actually that saves clients money. The third kind of person in the mix is me, right? It's the broker dealer or it's the investment advisor who is responsible for the client relationship, and that firm gets paid on the front end of the investment for placing the investor into that overall DST. The way that we talk about the fees are they're either an operational expense, which is usually an advantage in the DST to the traditional asset, or it's a organizational and offering expense, which in my opinion is a disadvantage to the investor. And I'll lean into that for a second. The disadvantage is that the sponsor had to go to the street to buy the property. And let's say they bought that property for 90 cents, okay, not 90 cents on the dollar. Then they added the acquisition, organizational, and offering expenses to that, and they're selling it to investors for $1, okay, using my hypothetical. My biggest question, and our due diligence team finds the answer to this question, is what is the property worth? If the property is worth 90 cents, that's not a good deal for the investor, and we'll likely say no to that deal. If the property is worth $1.10, then that's a good deal. The dollar is the right price to pay. You're actually buying basis on that acquisition. But what has to be true in order for us to approve a deal? The sponsor has to have some sort of an advantage on the acquisition that they're buying below market. So they have to be well capitalized or well networked. There has to be some unique asynchronous opportunity that came to them that allows them to stack fees on top of a deal that still creates an accretive acquisition for our client. So that's kind of the industry question that no one is asking. Like, if I'm paying this price, what's it worth? And that's a great question for your audience to ask people like me.
I love that. I love that. As we wrap this up, one other question I often hear is, well, if I own my property, I need a 1031 exchange, but I still have a mortgage on the property. Does the DST still work for me?
Yeah, great question. About half of the DST market today carries a loan as a part of the investment structure. And so what that means is that sponsor company, they acquired a property, let's call it a $50 million property. Okay. They acquire that property from a broker, right? Competitive or non-competitive process. They buy it for 50 million. They structure the trust, they structure the investment, and they go to a traditional bank and they get a CMBS loan of $25 million. And that 25 million gets layered into the investment structure. And now we have this fully syndicated $50 million property where the sponsor is raising 25 million from investors, and they already have a $25 million loan in place. And what that means is that for every fractional interest that investor buys, half of it will be debt and half of it will be equity. And so you can consider the 1031 exchange proceeds as a down payment, right? You can bring $200,000 worth of proceeds into this offering, and you'll close on $400,000 worth of the value of that property and own $400,000 of that $50 million offering. So you want to understand that the debt in your current portfolio, right? Because you want to have a plan for how to manage that debt going forward. The debt in the DST is non-recourse. So you can never be upside down. You can never, owe more than it's worth, quote unquote. And it can never, the limited liability of the DST, you can never lose on balance sheet assets if you have a problem with the property in the DST.
That's great. Is there anything else that if someone's exploring this idea of DST that they need to know or understand? What else?
Yeah.
I think we hit on a lot of those pieces. Is there anything we missed?
One big one that we haven't hit on is that about 5 years ago, Wall Street got very, very involved in this problem that we've been discussing. This retiree investor who doesn't have a solution for the real estate portion of their portfolio, and major alternative investment organizations that you'll have heard of through other investments like infrastructure or private credit or real estate have created DSTs that have an accelerated and an intentional path toward a REIT as an exit. And so you'll hear the terminology 721 exchange or 721 UPREIT. What this effectively enables, and we can do a whole nother podcast on this, is for an investor to 1031 into a DST, where that DST's intent, the exit intent, is to be acquired by a REIT. And oftentimes that REIT is an affiliate or it's the same sponsor as the DST. So it's an intentional path where the REIT buys the entire DST, like all of the assets, and all of the investors come with that asset and roll up into the overall parent REIT that is going to be a long-term investment for those clients. And so those clients who participate in those DSTs, they do so solely because they want exposure to that real estate investment trust. Today, there are 13 of those that exist in 26. My hypothesis is that in 2028, there's going to be double that. And it's because the world is trying to solve this same problem for investors. How do we help an investor retire? The REIT as a structure is entirely different than a DST. It's not real estate anymore. It's a business. It's an operating business that operates real estate. But the returns that are being driven to investors are operating business returns. And so as such, there's a whole lot of other things that need to be evaluated prior to selecting that REIT. And again, I would encourage investors to reach out to our office, and we can educate them on the pros and cons of that strategy and the differences that exist in the market today.
And what are the paths to communicate with you or to connect with you if someone would like to maybe have a consult or find out more information? How can they connect with you and your firm?
Sure. So if you're watching this on YouTube, I'm sure Matt will put my email or link to my calendar in the description below. But my firm's name is JRW Investments, and our website is jrw.com. There's a contact form on that website. It's pretty easy to find. And you can just reach out through that contact form and ask for John Taylor, and I'll reach out to you. Most of my time is spent in consultation and education with clients. And so I'm happy to hop on a phone call and discuss your scenario.
Awesome. Thanks so much, John, for demystifying DST and some of the 1031 things. I know that this will help a lot of people understand more about this.
Thanks, Matt. Thanks for having me.
That's it for today's episode of the Wealth Transfer Podcast. If you found value in this conversation, would you leave us a review? That would be just so honoring to us. We'd appreciate it. And if you know somebody who might need to listen to this because they're thinking about their next chapter, will you send them a link to this podcast or this video so that they can listen more as well? For more episodes and expert insights, be sure to follow and subscribe. That means the most to us. Follow and subscribe, please, please, please. And when you're ready to take action on your own real estate plan, or if you need help with wealth transfer planning, we know a number of experts in all the different spaces. We'd love to connect you with them. You can reach out to us via direct message or comment. You can email us, matt@templeton.realestate. No .com, just templeton.realestate. And I'd be happy to connect you with an advisor. Thanks so much.